Hello, welcome everybody. Thanks for joining us today for another Family Office Insights opportunity. We're super glad for you to participate with us and welcome our friends at Broadway Strategic Return Fund. I want to make sure I say that properly. And they're new friends of ours, and so we're super excited. As many of you know, I'm a New Yorker and spent a lot of time enjoying the city, including Broadway, so we're big fans. And without stealing their thunder, they figured out how to make money at this and enjoy the ride. So you're in for a treat today. Just to be clear, we can't hear or see you, but we know you're there. And I would encourage you to post your questions to the Q&A and the chat as they come to mind. We have a lot of people coming on today, so we'll get to as many as we can. Also, after you see what you see today, if you're interested, we'll make sure that you can easily connect with Jerry and company. And also, if there are others that you know that might benefit from seeing what you see today, you're certainly welcome to make sure you connect them with Jerry and the folks here. So please feel free to do that. If it's okay with you guys, we're going to record this and
Sure.
subject to your approval, we'll share it with the wider audience of Family Office Insights, those who weren't able to come today and that sort of thing. So
Absolutely. As
just
you know, it's our favorite topic.
yeah, exactly. So, and also the audience, if just note that it'll be on the Family Office YouTube channel to share with others as well. So, thanks for joining us today, Jerry. Welcome. Please take it away.
All right. Thank you so much, Arthur. And thank you, everybody, for being here. We really appreciate the opportunity to talk about the Broadway Strategic Return Fund. We're here to hopefully tell you a great story, a great opportunity to invest in live theater around the world. We in this fund, which has been around now for 11 years and averages 18% net a year. With that said, since I probably will talk to those of you who are interested later on, I'm going to keep my comments very short because Curt and Cronin and Hunter Arnold, who are co-founders of the Broadway Strategic Return Fund, will walk you through how they handled a very inefficient space. So when I say Broadway, I know there's a lot of imaging in your head, whether it be from the producers or your personal experiences or whether it's live theater. The one thing I would add before I turn it over is just think of this as a highly inefficient industry with a couple of moats that keep people from making it efficient. First moat is lack of information. There is no centralized database or even a database you can buy to develop a cohesive institutional strategy. Two, it's a very limited amount of full-time producers between London and New York, so you need access to them in order to allocate your capital. And that pool stays small because theater ownership is very concentrated, and I don't need to tell you, it's incredibly expensive, highly unionized real estate, so they don't trust newbies. The team, both Hunter and Curt have spent years developing the strategy. It's been live for 11 years. Curt Cronin, prior to being successful on Broadway, graduated top 5 of his class at the Naval Academy and decided to go into the low-stress job of being a Navy SEAL.
Ah, yeah.
After 20 plus years, he retired as head of operations for SEAL Team 6, so I can assure you operations run very smoothly on this strategy. Hunter Arnold, actually like Arthur, successfully exited a tech company he co-founded a long time ago and came back to his first passion as producer at Broadway. He has won in excess of 11 Tonys in addition to leading a successful production company and with Curt, this fund. So enormous amounts of experience. And with that, I'm going to turn it over to Hunter and Curt to walk you through the strategy and the opportunity.
Awesome. Thank you, Jerry.
Thank you, Arthur. Thank you, Jerry. And we are honored to join you today and really excited to share our passion, for Broadway. And I think the most important thing for me to start with as the operator is this is really an arbitrage-rich platform with where you get to invest for an outsized return with an unfair advantage, right? Like when Navy SEAL, I'll always be legal, but I'll never fight fair. And so hundreds of operations nobody ever got a scratch. And so as I left the SEALs, I said, how do I bring that passion for risk mitigation, protecting people's blood in the military and in the investment world, protecting, the fruits of your labor, your investment dollars. And so when Hunter and I first met in our Chime MBA and he started to talk about Broadway, I was uh, ecstatic to find an opportunity to have a platform where people, I always look for what's that sustainable arbitrage. We are fiduciaries where most people are investing for vanity reasons. They're donating for access, and we are the long-term money versus the short term. And so those two aspects, when Hunter first showed me that, I said, this is an opportunity for us to drive outsized return for our investors based on our alignment as fiduciaries and theirs, and to drive other outcomes. And so Hunter, I'll let you start talking about the passion for how you do it on theater, but really excited to share this with you.
Absolutely. Yeah. No, thank you for the introductions, Arthur and Jerry and Curt. I think Curt hit the nail on the head after Jerry's intro, which is we are really the Broadway Strategic Return Fund is actually a purely financial return-based vehicle that happens to invest in Broadway. The reason that we happen to invest in Broadway, as Curt mentioned, is he and I met in grad school. We did a program called Triumph, which is a triple program between HEC Paris, London School of Economics, and NYU Stern. And I had exited a couple of entrepreneurial ventures and was sort of taking a beat as I grew my Broadway producing career. And there's this project that you have, which is to look at a business that you might want to sort of start when you're out of school. And I had been looking at the fact that as a Broadway producer, and I'd been doing that full time for maybe 5 to 7 years back then, I had a lot of investors who couldn't separate whether they wanted to be an investor that was aiming for fiduciary results or whether they wanted to be a supporter that wanted the glam, the glitz, and the benefits of being involved in the entertainment industry. And I would get so frustrated, and I shared this with Curt, that people would say, "Hey, I want a return on my investment." Or a lot of times, frankly, in the arts, we get not our goal, but a lot of people's goals that they say, "I just want my capital protected so I can continue to support the arts." Um, and we would say, "Great, here's the strategy." My office at the time would say, "Here's the strategy. You can't pick shows just like you can't pick stocks. You're not going to beat the experts, so don't try. What you need is a portfolio that eliminates the sort of underwhelming people. Um, and then what you need to do is spread your money across things and let the market work itself out." If you actually invested across all of Broadway live theatricals, the annualized returns in the high single digits to low double digits. Um, really, when we set out to do this, the challenge was simple. And Curt, if you want to throw this onto the slide for me here.
Absolutely.
So
Which,
Hunter, before you do that,
yeah,
just because I've seen this movie before, not in the context that you're about to present it, which is fascinating, by the way, everybody. But 15 years ago, it's exactly what you said. Someone would throw 100 grand in just so he could go to the parties with the hot girls, right? And that was enough. And that was just like going on a vacation to the Four Seasons for a month, right? It was a rounding error amount of money, but the visceral experience was worth it. I think like being in New York City, I saw that sort of dissipate over time. People were saying, okay, I don't need to go to the party with the hot girls anymore. Does that really stop happening?
no. I mean, I would say that 60% of the industry, thank goodness for us, 60% of the industry, even those who represent themselves as fiduciary investors, are actually operating like vanity investors. And by the way, Curt and I don't use the term vanity investors um, derisively. The industry is thrilled to have people that really don't much care one way or another if they win or lose money because there is a lot of art out there. It's not necessarily the stuff we aim to invest in, but
Yeah,
there is a lot of art out there that needs philanthropic support or that
yeah,
needs
totally.
non-financial outcome-based support.
Yeah,
What I think you saw start changing 10 or 15 years ago, Arthur, is that as as our world became more about data, there became a larger percentage of people that did care about whether you could in fact look at it as a place. And when you look at that, to your introductions, I didn't start in the theater industry. I started in the technology and sales and marketing spaces. And when I came to the theater, I thought, holy cow, there's a lot of arbitrage here, which can frustrate you, right? Because your initial response can be, this is not a very professionally organized industry.
Yeah.
But then you start thinking about it and you go, wait a minute, if I could be the guy that pulled those levers and tugged those pulleys,
Yeah,
this
imagine
could
that.
actually, I could have materially different returns than the rest of the
Yeah,
market, right?
smells like opportunity. Yeah. Yeah.
That's exactly right. So I would say, as you'll see when we've gone through here, um, a lot of the existing vanity investment dollars are precisely the people that, by the way, our return, which is 18.5 or 18.8-ish% over 11 years, that includes the pandemic where we were shut down for almost 2 years.
It's a good
So
thing you were operating well, right?
yeah, that's right. But we would have been, I mean, if you excise the pandemic, we would have been in the mid 20s. And the reason for that largely is because many of those vanity investors, the moment the glitz and glamour stops, we'll talk about this a bit in a few minutes. But for example, they do want to go to Broadway's opening night, so they want to make that investment. That's the most risky point in the life cycle of a Broadway show is in New York, most expensive, highest unions against the greatest competition. But they'll make that investment because Nathan Lane or Bernadette Peters is going to be at that red carpet.
Yeah.
Then the show works and it goes on tour.
Yeah.
Well, they don't want to go to a party in Schenectady.
No, right.
So
Yeah, right.
they skip the tour, but the tour is a guaranteed return-based process because you're actually now licensing it out to the presenters and it's not at risk. It's a cost plus proposition.
Yeah.
So a lot of what we do is as simple as saying, let's solve the problems for the investors that want to make money. Let's give them a structure where they always can make money in the system if they follow a certain set of rules. And then let's take the sort of arbitrage benefit of the investors who aren't behaving like they want to take money and let's let them take the risk. And we're happy to coattail them on the basis of that risk.
Yep. Totally makes sense. Thanks for sharing that. Yeah.
Yeah, of course. So here you see like when I was originally doing this and before Curt and I got involved and he started sort of whiteboarding with me, these are the four problems that we had, right? One is access. It's easy to say to somebody, to Jerry's point, just invest $1 in every Broadway show that opens. Very difficult to get access for that because you've got a half a dozen to a dozen in any given year independent operators. They all have their own ways to do things. They all have their own constituencies and they're competitors.
Mm.
So to tell the individual investor, hey, go find this year's 12 new musical producers and put money in with, well, they may not want you to do that. They in fact might say, you put money in down the street, your money's not welcome here.
Yeah.
So access, number one problem. Number two problem is any given individual production looks like VC. So it's not a real estate investment. If a show goes south on Broadway,
It gets flushed to zero, huh?
yeah, you don't lose 15%, you lose 95%. That's exactly right, Arthur. Third is it is an industry that has little accountability because we don't have any activist share owners, right? You've got your investors that say if the party was good enough or the New York Times liked it, I may not even be looking at your financials.
Yeah.
I can't think of a single story in history where a producer was removed from operating their show. And there certainly have been some examples where in the greater markets, that CEO would have been replaced.
Yeah.
And then the last thing is because every individual production and every iteration of a production. So let's say we do, we just opened a new musical of the Lost Boys last week. Let's say you do the Lost Boys. Well, that's one LLC, one K1. Then you do the Lost Boys on tour, second LLC, K1. Then you do London's version of the Lost Boys because you as the investor have that proportional right. Well, now you've got UK withholding, a tax, an FX swing. Then you've got another tax. So it's not scalable for the average investor to say, give me a big basket of these things. And those were the problems that we were sort of going to attack.
Yeah.
So Curt, maybe you want to talk a little bit about where we started trying to build the strategy?
So first we'll dive into and that strategy drove us to these results, right? So the fun part is you're getting to join us 11 years ago, we said, hey, this is what we think is going to happen. And the awesome part is here's what's occurred, right? And so you can see, we were on a roughly a 24% growth rate through the pandemic. And then the pandemic, Navy SEALs love crisis is danger and opportunity. We were able to go from 25 million to 100 million under management while we were closed for the pandemic because many of the institutional investors saw that not only could we run offense, but we were on defense, right? We had Hunter was instrumental in part of the SVOG, the Shuttered Venues Operator Grant, which with the government program for that, we had the highest insurance in the industry. And so that enabled us we really had three different phases of operations. We had shows that were open and had been producing cash for a long time, which once we were secured them, they were the ones that did as well as or better had they been open because of those programs. The second was shows that were in the process of opening that we had to close down and set up for the future. And then the third was the shows that we had the IP that we just moved that down in the timeline. And so what you saw for us was COVID was difficult. One of the actual more difficult phases that you can see in our data room was once we reopened, there was a glut of content. And so you see that J curve where we had a whole bunch of primaries closed. And in our industry, the primaries, we close those fast. In fact, it takes 11 years to build a show, but once it opens, we very rapidly know it's going to be successful or not. If it's not doing well, we'll close it so we get that reserve back to put into other investments. So the high risk primaries that don't make it close fast, and then as Hunter was alluding to later or earlier, then we'll roll out the tour 18 months later, the UK sit down, then we'll continue. So winners win over decades, and then losers move fast. And so what you see is pre-pandemic, we were on the growth trend for the first series, and then now we're on that second series. Once we come back to that glut of content, we're now taking all of those ancillaries and driving that growth again. And so we're most excited about as we move into decade two. Decade one, we had to invest in the primaries to get the ancillaries. And our mission was if we could build a franchise or one with over 3 productions every other year, we thought we could be successful. We've now done 11 in 10 years, so 1.1 per year. So this year, or last year, 60% of our capital was allocated to ancillaries, those high return platforms. So we're really excited about as we move into the second decade, we now have all the advantages of what we built in the first decade.
Is there an element during COVID that the investors saw an entry point advantage? Like, for example, if you were a fund or a share, a stock or an ETF or something that had an NAV, did the NAV drop so it was a good entry point?
You mean for our investors or for
Yeah,
investors in the space?
your investors.
Yeah, so if you can see there, if you look at that sort of like the difference between Q4
Yeah,
of 19 and Q1, right? There was an NAV drop. And by the way, the way we did that NAV was to go, who knew what they were doing at the time, right? You did the best that you could, but that NAV drop was driven by an analysis of every crisis Broadway has ever faced. So we looked at everything from 9/11 to Hurricane Sandy to union closures. And we basically said, when Broadway gets hit by something seismic, how does it react? And then from there, and so that NAV drop, Arthur, basically is the difference between what history said would happen in an unlimited suspension, right?
yeah.
Minus what we knew our insurability was.
Uh,
So what we with some probabilistic overlay because we knew that the insurance carriers would probably fight us for a while.
yeah.
So if you looked early in that, we were presuming like 80% we'd get our insurance, and then it quickly moved to 100% is. But mostly what happened in the pandemic, most of it was, Curt has alluded to this primary versus ancillary. So when we say primary, what we mean is the first time you try out a new title commercially. So this would be like when you put Hadestown on Broadway for the first time. That is the riskiest, as we discussed. New York, unions, high expense, high competition, 40 other shows competing with it every night. But it also holds the IP of that content. So if it's a home run, that mother company or that primary becomes the licensor of everything else you do.
Oh,
So
cool.
long past New York being closed, it's eating off of the sort of rising tide of the title all over the globe, all the way down to high schools doing it.
Yeah.
So a lot of what we saw in the pandemic was these investments are built with proportional rights. So if you're 5% of that primary as an investor, you are then entitled to 5% of the ancillaries. But if you drop out, there are no cherry picking. You get out of line. So
Uh,
we were seeing people in the pandemic, obviously the market, right? They say money moves from shaky hand to steady hand.
yeah.
We were seeing the market go, well, I'm not going to write my check for a tour I did the primary right before the pandemic.
Yeah.
Broadway's shut down right now, and you're asking me to commit to a tour. We don't even know when we're coming back or what that market's going to look like. We soaked up as much of that optionality in the entire marketplace as we
Nice.
could.
Yeah.
And frankly, that optionality is still paying off and will for about 6 more years
Good for
as
you.
the titles from 2020 continue to play out globally.
And Arthur, to be clear, like what we traditionally have seen is 25 to 45% of people will pass on their rights to that tour. In the pandemic, we are seeing massive allocations of people that just vanished. And so we took all of those ancillary allocations. And to Hunter's point, once we've taken that in the next one, there's no cherry picking. So we get to continue to increase that allocation. So we actually jumped forward in year 5 to where we thought we'd be in year 10 or 11 because we could now allocate more to the ancillaries all going forward.
It's like having, buying shares on the open market or having treasury shares. I like it. Right.
Well, it's almost crazier than that, Arthur. Sometimes for us, it's like somebody puts their money into a company as VC, and then they give us all of their options without us having to have bought originating shares.
Nice. Yeah.
Yeah, I mean,
Yeah.
it's when it works right, it can really work. And Rhonda, by the way, great question. I saw it in chat, so we will get there. We've actually got a slide on this coming up. Kurt, do you want to pop to the
Great.
next one, and
Yep.
we'll get
Absolutely.
towards this? So this is what the actual market looks like. This is not what our allocation looks like. This is, and by the way, this is the market that matches our historical data set, not the current market. And what this is showing you is that Broadway is actually the smallest segment of the marketplace. Touring, pretty consistently over history, is double the size of the Broadway marketplace. And let me talk about the difference between the economics of touring and the economics of Broadway. On Broadway, your investor and producer eats last, right? It's an operating business. So theater owners getting paid, actors getting paid, writers getting paid, guys selling merchandise is getting, and then if there's any money left over at the end of the day, you start return of capital. You've then got to get all the way through that before you have return on capital, right?
Yeah.
So it's a very long road for the investor to get made whole on those primaries. In the
Yeah.
rest of the market,
That it gives me like a shudder on that waterfall, right?
well, here's what's even crazier, Arthur. After that, once you have return of capital, there's a 50-50 waterfall, that's about the industry standard, on return on capital because there's so many creative people participating in net profits
Yeah.
that so it's even when you get there, then you're eating less than your originating share.
Yeah.
So you have to do something to correct for that. And what we do to correct for that is take advantage of how the market exists, which is once you've proven viability on Broadway. And by the way, viability doesn't necessarily have to mean a profitable operating business. It means a show people will show up to see and pay top dollar for. Then you've got about 130 different theaters just across the US. And they've got subscription seasons where you sign up to see the 5 or 6 Broadway shows that come through a year. So they've got their revenue pulled forward. It's guaranteed in advance, but they've got to, as presenters, first of all, bring those 5 or 6 shows. So they've got to have enough content.
Yeah.
And second of all, if they want to maintain their subscriptions, they better bring the hottest 5 or 6 shows so that you keep subscribing year after year. So the way that they get us, Broadway producers, to bring our content is they've got to pay to play. So if I've got, let's say, a lukewarm show, it did well on Broadway, but it's not a juggernaut. That person's usually the presenter. So they want me to now come to Chicago for 4 weeks because they've got enough subscribers to fill their theater for 4 weeks. They've got to guarantee my expenses. They've got to guarantee a small profit margin. And then over and above their subscribers, we've got a ticket split. So for every single ticket that they sell, I might get 60, they might get 40. That's about the industry norm.
Yeah.
If I'm Hamilton, I'm getting 100% of the ticket split. Much like in the olden days, how, big summer tentpole movies at the movie theaters got 100% of the ticket take, and the movie theater was there to sell really expensive popcorn and sodas.
Yeah.
Our business isn't that different. And when you look at this chart on the lower right, what you see is just the US touring market is double the size of the Broadway market.
That's
So a
insane.
huge portion of the game we play, and this goes to Rhonda's question, if we were only playing in
Hang on.
primaries,
Let's just tell the group what Rhonda's question is. How much of your 18% CAGR is due to the touring shows versus the original Broadway production? And do you also invest in regional theater production? Just so everybody knows what question you're asking.
yeah, no, thanks for the clarity there.
Yeah.
So The simple answer to our strategy is we want to take the smallest, latest bite we have to out of a primary in order to have the highest optionality into the ancillaries. When we
Smart.
started out, and this is kind of Curt's point about how the pandemic pulled forward our future returns for us. When we started out, A, nobody knew who we are. B, we weren't throwing impressive money around on the street. And so we had to really support shows early and at relatively large amounts in order to get all of the terms that we wanted on the optionality of the ancillaries.
Love it.
We are now the single institutional investor in the entire space.
So
And
go
go
ahead.
ahead.
I'm sorry. I'm just anxious to ask a question, and I was listening.
No, please do. Go
I
ahead.
wasn't just thinking about my question.
Shoot, Arthur, shoot it.
So, is it fair to say that the Broadway shows are the luxury brand Fifth Avenue store, and the rest of the stores across the world are the ones that make money?
Here's where I will change that metaphor, which is a Broadway show or a West End show, because the two places you can start a primary are
Yeah.
London and New York, right? Nothing really launches commercially anywhere else. Um, a primary doesn't have to be a loss leader. There's nearly no Fifth Avenue luxury boutique that's not a loss leader. When they work, they actually can generate really attractive returns, but they don't have to work to create a luxury brand, if that makes sense.
Got
So
it.
it's
Yeah.
almost like you have an
Yeah.
A and an A-1
Yeah.
operating strategy.
Yep.
I'll give you a great example of this. You can have a show like Hadestown, which is a show of mine that the fund originated, and which we'll show you some data on in a minute. That show recouped on Broadway. First of all, unknown title, which means no royalties to any underlying rights, right? So if it's profitable, it's really juicy because there's not a lot of hands in the cookie jar. Um, but it took us about 8.5 months on Broadway, and we were a hit. It took us about 8.5 months to recoup.
Hmm.
Cast recording took 17 weeks to recoup. The tour took 3.5 months to recoup. Like everything after that gets better and better, and your costs go down, right?
Yeah.
The other thing is when you go on the road, and this is also a little different than your Fifth Avenue example, and then I'll have Curt walk a little bit through how this sort of rollout of a franchise works, is typically your real estate on Fifth Avenue has your highest foot traffic. So even though the real estate's expensive, you're getting more people through your Fifth Avenue show store than you certainly are getting through your Columbus, Ohio store. In touring on Broadway, it's inverted. Because on Broadway, we have these tiny historical theaters. They
Yeah.
average a little over 1,000 seats,
Capacity, right? Yeah.
and you have to run forever.
Mm.
When I stop with a tour in Chicago, I only have to run there for 5 weeks. I can jam as many, I can create ticket scarcity and therefore pricing variability much easier in a limited environment. So in Chicago, if I'm only going to be there 4 weeks, 6 weeks, I can go into a 3,500, 3,900 seat theater. It doesn't cost me any more to put what's happening on stage on for 3,900 people than it does for 917 in New York.
Yeah.
So the scale of those profitabilities get much better. And so, Rhonda, I'll circle back to this and then I'll turn it over to you, Curt, which is if we only invested in primaries, we only have one strategy. And that strategy, by the way, is a data-based strategy we could talk about in a bit. And that strategy is not to pick winners. When we set out to do this, we thought if we collected all of the data on Broadway's history, which by the way is a very difficult process because it's all private, but we went through and sort of begged our way with every peer in the industry. Hey, will you share your final K1 of this show from that year with us? We spent years, 3.5 years, compiling our database. We thought it would moneyball us how to pick winners.
Mm.
You couldn't regress one factor that consistently picked a winner.
Wow.
What we learned, though, was boy, could you quickly identify the statistical losers.
Yeah.
So our only strategy for primaries is eliminate the lower half of the market probabilistically. All we're looking to do is eliminate. We don't select in other than qualitatively, but quantitatively. And when I say qualitatively, I mean good operating team, history of success. I don't mean qualitatively from an art standpoint because we're totally objective. There's no subjectivity in our selection process. But on Broadway, our CAGR would probably be 11.5%, something like that. The market would probably be 7% if you just did Broadway primaries.
Yeah.
So a good deal of it comes from the rollout of those ancillaries, Rhonda.
Yeah.
Yeah, and this is the
Good.
part we really get excited about operationally. So you can see here, we invested $250,000 in Hadestown, which was Hunter's show that won the Tony in 2019. So we invested $250,000 in that show. As we have rolled out that franchise, and the awesome part, this is still a young franchise, still in the process of rolling out, about halfway through its rollout. We now have 11 times that capital invested in the high return, low risk productions to follow. And the fun part is where we are already have $4.6 million distributed to date. So we're investing with house money. And so what the fun part is, you get to scale extensively the return aspect of these productions. So I'm going to flash back to here. What's really exciting, this graph assumes that you only have your pro rata rights. So if you invest 2% in the show, you have 2% in the tour. What we negotiate for, and what Hunter talked about, what we're really excited about, every time we invest, we negotiate for the right to pick up all the other capital that people pass on. Because the fun thing is, I love triangles. We're solving the producer's problem,
Yeah.
right? Their hardest part is raising capital. Our whole desire is to allocate capital to the non-star driven, high return touring productions. And so we're solving their problem. And so there's a virtuous cycle where this is, if you imagine your pro rata. Now, if you imagine 2 to 4x allocation of your pro rata, you can see the touring part, just like you saw in our 11 times allocation, becomes huge. And so this is the part, this is my favorite operational graph is most industries, low risk, low return, high risk, high return, right? It's the fundamental market truth. This industry is inverted. If you looked at it, and Hunter talked about this, the primaries there you see in blue, it's high risk because your presenter takes the risk to bring the show to market. And so, to Hunter's point, an individual show may be a massive hit, but the aggregate of primaries is high risk, low return. The fascinating part for us is once it's successful, the part we're fascinated about is the tours, the non-union tours, the film, everything else is higher return and lower risk.
Yeah.
And no one else in the industry wants it because there's the stars, it's not SEAL deployments, but the stars don't go on tour. And so this is really the aspect that once you see this graph, like this is what the whole fund's thesis is built
Isn't
on.
that wild? You're basically uh, buying the options that in the VC context that somebody gives up in your example, Hunter, and they're the most profitable with the least risk. But
That's
people don't.
exactly right. And
Yeah.
and sometimes people ask because it sounds implausible, right?
Yeah.
And in a non-vanity business, it would never happen.
Yeah.
But people go, does somebody really they take this risk on Broadway and then they drop out when it goes to tour?
Yeah.
First of all, I'll tell you, even on the biggest hit shows on planet Earth, um, Hamilton is a generational hit, right? I mean, it is unlikely I'll see another Hamilton in my lifetime, certainly in my producing career. Um, People dropped out of Hamilton. Now in Hamilton, people dropped out because they pass away and their heirs don't want to follow it up. They get a divorce. They have bad time. Everything's a new LLC, so you have to put more money back in. People get in. So now Hamilton might only have, let's say, a 3% dropout rate, whereas an average show probably has a 40% dropout
Right.
rate, but there's still dropout. And so for us, the key is negotiating way up front, which is, and by the way, the producer doesn't want that money. They don't care who fills it. In
Yeah.
fact, knowing who's going to fill it before the dropout happens gives them one less night of sleeplessness,
Ah, yeah.
right? So to Kurt's point, we are solving the producer's problem by putting ourselves in the most attractive eating position. And then I think the other thing that Kurt is doing with this slide, showing how bizarre it is that the lowest risk has the highest return in our market. I would say it slightly differently, which is investors in our market are more statistically likely to invest the sexier a show is. More stars, more glitz, more sets, more. They are less likely to exist the less sexy it gets. It's in Cleveland. There's no star anymore. Like we have a show that won last year's Tony Award called Maybe Happy Ending, and our star Darren Criss who's a Golden Globe winner and now a Tony Award winner. He won the Tony Award for Best Male Performer for Maybe Happy Ending last year. He's leaving this month, and everybody keeps asking me like, "Oof, you guys have got to be." That's got to be brutal for you that he's leaving. Does that change? And I'm like, no, no, no. He spent 2 years in the show branding it for me. and now he's taking his $90,000 a week salary and going away. My brand is still my brand, but I get to replace him with somebody that's
Yeah,
$6,500.
right.
Right?
Yeah,
It's a huge, and by the way, I'm capped on that show. I only have 900 seats.
yeah,
So $90,000 of $1.1 million in available gross every week is an enormous operating expense.
yeah.
So it's a really wonky business. But the reason people drop out, it's not just death or divorce or financial trouble. It's often because many of these investors, you mentioned Arthur, remembering when people would throw 100 grand at a show to, people will put their money in the show to get their name on it. Because if your name's on a show and the show wins a Tony Award, you win a Tony Award.
You win a Tony. Yeah,
That's a pretty glamorous thing to be able to do.
yeah.
Um, but
Nice,
guess
nice
what?
cocktail party talk.
But guess what? Once you've won that Tony Award, you investing in that show on the road, then investing in that show in London, then investing in that show in
You don't get
Australia,
another Tony for
you
that,
don't get
right?
another Tony Award. But if you take your gains and
Yeah.
put it in a new show, even if that new show has infinitely more risk, you might win another Tony
Another
Award.
Tony, yeah.
You
Very
do
interesting.
get another opening night. You're gonna walk another red carpet. So all of that stuff, people push to the vanity side of the exploitation instead of into the economic side of the exploitation.
And when you take advantage of the options for the people that drop out, is it a negotiation in advance or can you buy them at a discount?
So it's you can't buy them at a discount, but the good news is in this business, and this is sort of a wild permutation as well, you are always buying at originating value, meaning so you unlike a
Par.
normal
Let's just
business,
call it
right?
par, right? Yeah.
Yeah, that's right. So
Yeah.
so when you do your Series B, you don't raise your price per share.
Yeah.
It's still just a dollar. If you have 1% of the capitalization,
Yeah.
you just are 1% in series. So there's no cost adjustment.
Yeah.
So technically, I would argue every single ancillary is being bought at a discount by
Mhm.
definition, right?
Yep.
It just doesn't happen from a discounting format.
Got it.
And
Kurt,
well, just to close on this slide, what's really exciting for us is when I joined this endeavor with Hunter in 2015, you really had West End, New York, you had US touring, and you had West End and a little bit of UK touring. What's really exciting is the proliferation of the theatrical space. Live capture didn't exist. Hamilton created live capture, and so like we'll be headlining at the Tribeca Film Festival with the Hadestown live capture, and so you continue to see the proliferation of more art forms, which for us is exciting because that just allows us to take more platforms by which to take a successful piece of IP and extend it.
Yeah.
yeah, when we started, the entire TAM of international extensions of Broadway or West End product, the entire TAM annually was about $400 million in new capitalizations, total international capitalizations. In 2026, it'll be somewhere around $2.5 billion.
Wow.
So in a decade, that international market, I mean, Australia, Asia is now a huge market. South Korea has become a huge market. Prior to the current political situation, the Middle East built 27 new venues in the last 6 years just to bring Western entertainment over there that are purpose built for things like Broadway
The
shows.
Emirates and that sort of thing.
You
Endless
got it.
amounts of
That's
money.
right.
Yeah. Wow. And part of that was driven by technology advances as well, right?
Absolutely.
Yeah.
It's technology allows us to do things with efficiencies we never could when everything took, 14 guys backstage tugging on hemp ropes to raise a set.
Yeah.
Now you build the back wall out of LEDs and your scenic area is changed out in a nanosecond. Well, the pixels swap over.
Isn't that wild? Yeah.
Yeah.
And this
So
one,
if you
we talked about this a little bit, but I'll use this is what's been most exciting for us is like we say we can't pick winners, but by the elimination of those less likely to recoup, Hunter's been the lead producer on 5 out of the last 9 best musicals. Now we'll talk about the location-based expansion, location-based in a moment, but this is really exciting because this creation of the franchises does a lot of things for us. The first is it drives the pipeline of producers all want to come to us to have their show produced. So it gives us the greatest possible access to the entire S&P 500 of the industry. It
So
also
Kurt,
sets
so Kurt, hold on one second. Since you brought that up, there was another question I had. I'm sorry to interrupt so often,
it's
but
your
the
island.
first point that you said was access. So why are they willing to take money from you across all these different places when prior to this they were like you're giving money to them? Go to hell, we're not taking your money. How have you?
I'll take that one, Arthur.
Okay.
When for the first 3 years that we did this, and I know I drove our team crazy, but I had a prohibition on us using the word fund in public
Yeah.
because I knew that if I went to my peers, first of all, there's only about 24 people that do my job in America and London combined, right? So there's 20 to 25 lead producers on planet Earth. The reason is there's only 80 theaters and half of them don't turn over because they've got Wicked or Phantom of the Opera or what. So you can only create so many new shows, 40 or so new shows a year. There can't be 700 people that do that, right? The market can't hold it.
Yeah.
So it's a very closed door club. None of the people with a spot at the table have any motivation to invite someone to dinner.
Yeah.
So first, closed door system. The reason we didn't say fund is I know my peers very well because there's only 24 of us. We literally see each other all the time. By the way, everybody, sometimes we're competitors and sometimes we're partners because that's just the nature of such a small closed door business, right?
Yeah.
Sometimes we have to work together on a show and then the next year our shows are competing for the Tony and we want to bleed each other out as quickly as we humanly can.
Exactly. Yeah.
So it's a very interesting sort of frenemy competition basis. And I knew if they heard Hunter's got a fund, what they thought is that we would come in and try to usurp what they love about their job, which is creating new art.
Yeah.
And so we told our team, we never say fund. They just think Hunter's going to raise some money for us. They're not going to ask where it comes from. They don't care where it comes from.
Yeah.
And then we're going to show them through action that we never tell them how to do the art.
Yeah.
We are betting on them as a jockey. We're certainly not going to tell them how to feed their horse.
Yeah.
What we are going to do is offer assistance in training protocols we've seen that work. So all the parts of my peers' jobs that they hate, managing the finances, struggling with the vendors, negotiating vendor and legal contracts, most of my peers don't want that stuff. We go, hey, we got a boilerplate we can share with you that helps us get to, they're like, that's great. So the answer to your question is why do we have an unprecedented level of access is we spent years before they
Worked
understood.
hard to get it, right?
Well, and we just spent years proving that we were trustworthy. And so
Yeah.
what we're seeing as now are guys that will take, pardon my language, guys that'll take my bullshit work off my plate. Their checks clear fast,
Yeah.
and they stay out of my art's way.
Yeah.
And that's attractive money if you're a lead producer.
Listen, certainty to close is worth a lot, right?
Yep, that's right.
Especially in this industry.
Yeah.
And I'll say to Kurt's point, just in case it sometimes is a little bit confusing, is we invest across the entire marketplace. So there are some lead producers we will not invest with. That would only be because of statistic relevance that says that's not a good bet.
Yeah.
But we'll invest with anybody that passes our minimum criteria. We don't just invest in my shows. I'm probably less than 30% of our historical investments. And that's just because I happen to be a high volume producer. Some of my peers do a show every 5 years. I tend to do 5 to 10 shows every year. So
Yeah. Got it. Super helpful. Thank
Hunter,
you.
we haven't told him much about you. Tell him a little bit about Maybe Happy Ending.
yeah. So I mean, maybe happy ending is there is a type of show that we love. And I'll speak slightly here. It's going to sound like I'm speaking of art. I'm actually speaking about design, financial design, and operational design, which is we want a show where it's very obvious how you do a big, flashy Broadway version of a show, but that also 20 years later could be done in a high school parking lot with folding chairs and shopped at Goodwill and is inherently producible. Because if you do that, what you've done is you've created IP that goes into the world that can live a very long time and throw off evergreen funds for a very long period of time.
Doesn't every high school do Pippin, right?
It's so funny that you say that because I always tell people that the shows that we're building are shows off of the Godspell and Pippin DNA,
Yeah,
right?
yeah.
And that's what it is. You can literally do Pippin with no set. You can get your mom's old stockings out and turn them into a hat. It doesn't, right? You can do whatever you need to do for that show. And so maybe happy ending is a great example. Oh, by the way, the other thing we want when we can get it is you want what I just described with no underlying rights. Now, hilariously, the industry thinks that this is a hard thing to do. They're like, well, isn't it easier to produce Moulin Rouge than it is an unknown show that has no existing brand? And I'll tell you, I worked on them both, and I can answer the question is unequivocally no. On
Uh,
Moulin Rouge, I got to fight the film studio. I got to do a deal with them. I got to fight Baz Luhrmann, the original director and the IP holder. I got to fight with him. I've got 27 different pop stars from Madonna to Britney Spears to that I've got to go negotiate song
oh
rights
man,
deals to.
yeah.
On Maybe Happy Ending, I got two kids from Seoul, South Korea that wrote a show. I saw it in a little tiny black box theater, literally on folding chairs. And I went, hey, I think I know what to do with this thing to make it work on Broadway. Now, you could argue it has a lower chance to succeed than Moulin Rouge, but when you land that plane, that thing is a cash cow for a very long period of time. So that is the archetype that we like best in our primaries. No underlying rights, very controllable costs. The Broadway version of Maybe Happy Ending has an insane set because it's only a four-character musical. But that means so the set's very technological and it does a lot of things that no one's seen before on Broadway. But I'll tell you what, robots work for cheaper than humans do.
Yeah.
And LED screens are easier to cart around America than giant set pieces. And so there are ways to build the operating model that delivers hugely for the audience when it comes to artistic value. That's important. It's not zero importance because if it doesn't deliver artistic value, people won't pay high ticket prices.
Yeah. You know,
But the model has to work for the investors.
this picture, it always blew my mind looking at credits on movies or anything.
Yeah.
Because
Yep.
I'm going, wait a minute, all these people made money? Like all these people had to get paid.
Every single person
Except
on
for
that
the
stage.
producer is
Yeah.
the one that's financing it, right? And he's probably the last one to get paid. And I'm being harsh on purpose. All those people in that picture made money, right?
That is correct.
It's
That
wild.
is correct. Yep. And by the way, quite a few of those people on stage make money, but are those vanity investors that we're talking about, right? So they made money because the show's a success. But yes, I mean, the average Broadway show, and there's, again, what we look for all the time is arbitrage and dislocation. That's what we look for, period. Just like any other fiduciary.
Yeah.
The average Broadway show to do about $1 million a week in grosses has to spend, three to $500,000 on payroll and 150 to $300,000 on marketing alone. That's not the other stuff. That's not your G&A. That's not your. So you are really looking for the juggernauts, but you're not looking for the juggernauts to drive your returns on Broadway. That is a bonus when it happens.
Yeah.
You're looking for the franchises. Again, Curt defined this earlier, but we call it a franchise when we have three versions of the same production running concurrently. That it has achieved franchise status. We're rolling it out all over the world. And again, we always aimed for we could hit about 18 to 20% forever if we hit one every other year. Pandemic threw a bit of a wrench in that.
Yeah.
But we've hit 11 in 10 years, which is why we've been at those numbers even with the pandemic.
Nice.
And it's why if you kind of look at us coming out of the pandemic, now, what did you say it was, Curt? Last quarter, it was 60% of our money went in ancillaries?
No, the last year, 2025.
Last year. Okay. So yeah, probably even higher than that last quarter then.
Yeah. So on that chart where you showed that twice as much as it's a result of touring, what percentage of that additional amount or secondaries? I'm calling it secondaries, but the options that you bought out.
Yep.
Like, is it 10% of that, 20% of that?
Yeah, it's our average going into the pandemic. So if we were 5% of a show, our average is that we would improve that proportionality around 15-ish percent.
Yeah, got it. Yep.
Right? So our 5% would roughly become, 15% higher than that.
Yeah.
In the pandemic, we were having proportional increases that averaged 100%.
Yeah.
And now, because we've gotten better, frankly, at our negotiating and our contract language, and frankly, we wield a bigger cudgel, we probably average mid to high 20s permanently. And that's why you're seeing that curve get pulled forward for us.
Yeah. Very cool.
And by the way, that graph of the size of touring versus the size of Broadway, that's just touring. That doesn't include international. That doesn't include cast recordings. That doesn't include turning your IP into a live capture or a film or television presentation.
Yeah.
So a lot of other stuff that, again, with no disparagement, most of my peers finish a show and they can't wait to get out and create a new show. When I land a piece of IP, I can't wait to see that IP until I'm so sick of it because it's in every corner of the world, on every t-shirt, on every venue, on every format.
Yeah.
So we just have a different approach,
Yeah.
and when it's efficient, different is fun to be.
Yeah.
And when you're talking theatrical productions, there's really three ways to create new IP. The first is, as Hunter laid out, and we just talked about winning Best Musical 5 out of the last 9 times, the creation of new IP that didn't exist before. Maybe Happy Ending was just a story that went straight to this. That gives you permission to then drive category two, which is reimagined IP. Moulin Rouge won the Tony in 2020. It was reimagined IP. And then the third is licensing. And so because we've demonstrated operational success in creating, then now big brands like Hasbro, Disney, DreamWorks will now allow us to reimagine and license their IP because it's known to be executed at a high standard. So when we talked about two of those new franchises, Monopoly in 2023 and 2025 was Paddington won, the Global Licensing Award, which is the Tony Award of location-based entertainment. So Hunter, if you want to talk about the vertical integration of LBE and kind of the opportunities we have that we don't have inside of Broadway.
Yeah, so because we're always looking for sort of opportunity and arbitrage and sort of places where other people are leaving money on the table, one of the things that drives me crazy about the traditional London and New York theater business is, as the producer, as the representative of you as the investor, we spend all of the money developing the IP. We take all of the risk operating the business, and we spend all of the money building the brand and driving an audience. So it's my, and therefore your $200,000 a week that gets people to see our TV ad or hear our radio commercial and come into the theater. Because I don't control the venue, they then spend nothing.
Yeah.
They make you use their bad ticketing system with high cart abandonment because you're trapped.
Yeah.
They keep the data, which is tremendously valuable. You don't get your own data. Then they sell the $26 half glass of wine, which has high profit margins.
Yeah.
They rent me a space to sell merchandise, which they take a cut of.
Yeah.
So your extension of your own IP in New York and London is very low.
Yeah.
And so as the market has shifted over the last 5 to 7 years, people have gotten more and more into what used to be called experiential theater, meaning there's a thing called Sleep No More that was in New York for many years, or you go walk through a production, or
I've been there. Yeah. Did it. Yeah.
and that market has, by the way, grown. LBE, what's now called location-based entertainment, it was a $3 billion business in 2023. It is projected to be a $23 billion business in 2033.
I could see that. Yeah.
Right? So it's becoming very big. And the difference between Broadway and LBE, and we produce both, is in LBE, I go lease vacant space. I am the landlord. I am the restaurant. I am the bar. I am the merchandise. I am the ticketer. I do own my own data. And so as LBE has grown, we've really leaned into that space as well. It's probably 25 to 30% of our market of sort of new primaries are in the LBE world. And here's an example. This is Paddington, which you see the picture behind it is in a place called County Hall, which is right behind the London Eye. It's the highest footfall per square meter section of anywhere in Western Europe. And if I do a Broadway show, and let's say I sell a ticket for $100, my average net revenue is about $103, meaning after I get my share of merchandise, my share of anything else that is sold in the building, right? Repeat visitation. On Paddington, the average ticket price is about £51. The average actual revenue per ticket is over £100. And that's the difference between closed economy sales. Think Disney, right? I admire Disney as a business model. Once you get in that park, anything you ain't leaving that park.
That's it.
Anything you want to do, it's coming out of your wallet and it's going straight to the mouse.
Yeah.
And so location based gives us that opportunity, which is why that's also a growing focus.
Really interesting. So are they almost always a result of some Broadway play or otherwise West End play?
I would say right now, the trend, but again, these are trends, and trends have to be driven by the consumer. The trend is for branded or licensed LBE. So if you look at Broadway, about half the market has underlying material. It's a book adaptation, or it's a movie adaptation, or it's whatnot. If you look at LBE right now, it's more like 95% is on underlying rights. I think that's more because it's still it's still an emerging market. And when something is new and you're going to pay $100 to go see it, you'd rather go to, right? Broadway has a brand. You know when you go to Broadway, even if you don't like the show, you know you're getting quality,
Yeah,
right?
for
When
sure.
somebody goes, "Do you want to go see this new immersive theater thing?" And by the way, it's not based on anything. That seems real risky,
Yeah,
right?
it
But
does.
if somebody goes, "Do you want to go see this immersive theater thing?" and it's based on Star Wars, you're like, okay, well, how bad could that be?
Yeah.
Disney's not going to give that brand, Lucasfilm's not going to give that brand to somebody who's going to, it doesn't,
Yeah, yeah, yeah.
so I believe that that trend will shift over time. But for right now, the vast majority of our location-based stuff is like it's from Disney or it's from DreamWorks or it's from Hasbro or it's from, Nintendo.
It's
But I
kind of
think
like
that'll shift.
the Friends little pop-ups everywhere, right?
That the only reason that wouldn't fit in our marketplace is because we only do things that are narratively driven.
Yeah,
So so the Friends thing is more, it's almost more like a museum experience
exactly. Yeah,
with a cafe,
yeah.
right? Now, if you were seeing an extension of a Friends storyline there, it would suddenly fall into our world. If there were actors involved, it would suddenly fall into our world. But we sort of play in the contingent segment of the LBE world that we know we're great at, if that makes sense, as
Yeah,
content
yeah.
generators.
Totally makes sense. Super
So I
cool.
want to make sure, because I know, so we're running up on, I'm bumping up on your time. I just want to make sure, like, we believe the greatest creativity comes from operational discipline. And so, this is really the process, right? We source it through, hundreds of scripts that turn into, okay, now we evaluate, and a very small percentage of scripts ever gets to a 25-hour workshop. A very, very small percentage of those ever get to, now like a 3 to 6 week workshop. Very small, even smaller percentage of those ever goes to an out of town. So we'll test it in a regional theater, much like the demographic we want to target on Broadway. And an even smaller percentage of that ever comes to this very small choke point of West End and New York theaters. And so, unlike film, where, if as long as you can fund it, it can be made, there is a very selective process for Broadway just to get onto the stage. And so, like, our whole goal is we're continuously in a process of, it takes anywhere from 7 to 11 years to bring a show to market. So we have a continuous pipeline of, here's what's coming to market. And part of the fun game that we play, if Hunter was in the office today, you'd see every theater, the seating for each theater, and then when they're coming open, because part of it is making sure Dear Evan Hansen was pulled back a year to make sure it didn't compete against Hamilton. So it won the Tony in 2016 instead of
Yeah.
so
Little
we get to,
strategy. Yeah.
like, Once on This Island won the Tony in 2017 because when we looked at it, we said there's only 3 revivals this year, so this one has a chance to win Best Revival. And so it's part of that is making sure that they use everything possible. You never get to guarantee success, but like we want to use every piece of data available to us to get the highest probability.
Yeah.
Well, I want to peg on a thing that Kurt said there. I actually don't know that I've heard him use this phrase this way before, but I think it's really important, which is that we believe that the greatest creativity comes out of operational efficiency. Most people would say that sounds bananas, right?
Yeah,
You're
right.
taking a bean counters approach to creating
Flies in
value.
the face of the creative set, right?
But let me use a very real world example that I have spent a lot of time obsessing about. And by the way, there's a great book called Song of Spider-Man if you want to read about this, which is the same director, a woman named Julie Taymor, who's a genius, directed the most productive musical of all time, which is groundbreaking both artistically and productively, which is The Lion King. Directed The Lion King. It's the longest running show on Broadway right now, and it will by far be the largest grossing. It already is the largest grossing show globally. That same director also directed Broadway's biggest flop,
Biggest
which was
flop, right?
Spider-Man
Mouse.
Turn Off the Dark, lost over $100 million. And I
Wow.
will tell you right now that the difference is her producer on The Lion King was Disney. And if Disney knows one thing, they go, you can have full creative freedom within the following sandbox. Here are your fences. Your budget is X, your timeline is Y. Like, because if we can't stay in those fences, we can't do it. But boy, within those fences, you own everything. Go be as creatively as humanly possible. Um, on the flip side, on Spider-Man, it was a bunch of non-theatrical producers. It was concert producers, and it was U2. They'd never done any of this before. And every time they didn't like something, they just tore it up, threw it out, and wrote a new blank check.
Oof.
Creativity does not thrive with unlimited checks.
I believe it.
Creativity thrives when you go, here's six pieces of crepe paper, a pair of scissors, and some hot glue.
Yeah.
That's when really creative people come up with their best work. So
Yeah.
when people go, isn't a fund structure, isn't it going to choke creativity? No, it's not. You're giving people, that's like,
Guardrails.
yeah,
Yeah.
you're giving people bumper bowling,
Yeah.
right? You're like, I'm going to take the world's best bowler and then I'm going to take the gutters out of play. That's
Yeah.
all you're doing.
Yeah. Very, very cool. Wow. So that is really fascinating. Thrived and Lion King's going to do more than Phantom.
It already has done way more than Phantom in terms of global grosses,
Yeah.
like almost three times as much as Phantom. Phantom ran longer on Broadway, but because it is no longer on Broadway and The Lion King isn't going anywhere soon, Lion King will cross Phantom, I believe, in 4 years in terms of highest number of performances.
Wow. Yeah, my granddaughters just went to the Lion King. Like, who doesn't love the Lion King?
Oh,
Right.
the thing, I mean, it's still every week it has grosses like it opened last year. I mean, it hasn't slowed down at all.
Yeah.
So,
So one quick question before we wrap it up, guys. This has been amazing. Why don't more productions partner operationally? From our friend Jim. Jim, it's good to see you.
yeah, yeah. I mean, I think that the answer is threefold, right? One is because it's such a closed system, and I say this with love but admitted frustration. I'm, half a century old. In most industries, that would put me at the point where I should start mentoring and start slowing down. On Broadway, I'm like the youngster on the block
How about
of
that?
my peers,
Yeah.
because nobody leaves the table once they've got a seat. And so you have a lot of really good producers that have had a model that they've been working for 40 years, and every year the model gets less efficient, but they can still get a theater. Those guys don't want to, they are heading out on a celebratory lap. The last thing they want to do is turn operations over to someone else and have to learn a new way of doing things. So
Yeah.
that's one of it. The second is because of the vanity capital, there are producers. I will comfortably name one, not to be malicious, but to give you a very real world example. Our fund has never invested with Scott Rudin because Scott Rudin's producing model, if you look at it from a purely financial basis, is he would rather sell an incremental ticket at a loss because Scott pays himself as a producer. He's the only person that does it in this way. He will pay on first dollar gross, right? He
Mhm.
pays primarily in royalties. And so he'll get Bette Midler to do Hello Dolly. They'll have $20,000 left in tickets to sell for a weekend, and he'll do a $100,000 New York Times ad
Mm.
because an extra $20,000 puts another 600 bucks in his pocket, right?
Right.
By the way, that is also the way that the landlords get paid. They get paid percentage rent.
All of
So
them?
he's done a very smart thing,
Yeah.
a
Yeah.
very smart thing as an operator, which is he's aligned his own financial interests with the gatekeepers of the real
Yeah.
estate.
Yeah.
What he hasn't done is set up something that would pass our purely metric based, purely data driven, is it good for the investors,
Yeah.
right? Now, his investors don't care. Because like he's not doing anything that's not fully disclosed. They're like,
Right.
I just want to go backstage and meet Bette Midler.
Yeah.
And if
This
that
disclosure's king. Right.
if I make 6% profit when I could have made 35, I'm cool with that.
Yeah.
But we wouldn't invest in that. So that's the second pillar why people don't do that. And then the third, operationally, is a thing that we are trying to actively fight against, which is there's this function in the Broadway and West End community called executive producing. And executive producing is the idea that, let's say I'm a Hollywood producer, but I don't understand Broadway necessarily, the ins and outs. I then go hire someone that runs the show for me, right? I can bring the stars, or I can get the estate to give me the rights to the play, or I can, but I don't know how to run the day to day. So I hire an EP. Well, all of the EPs are general managers inside the space. Now that sounds smart. You're like, oh, go to the person that does all the vendor negotiating. But what you're actually doing is you're a CEO and you're taking your CEO, who you pay as a vendor. I mean, I'm sorry, your CFO. You're outsourcing your vote to that person. They have equity, but they have to take no risk.
Right.
it is an insane power dynamic, and it doesn't create for a lot of accountability or efficiency. But that's the historic provenance of when you say, why wouldn't somebody outsource operations? They think they are. They're just outsourcing operations with a broken agency agreement.
Yeah.
And so it's just taking us, certainly we've made huge strides there, but there's a lot of work left to do in terms of making sure that there is now alignment between producer and operator. There needs to be alignment between investor and operator.
Yeah.
And that's where we sit.
Smart answer. I get it. I wouldn't have never thought of the question. One last thing, because I'm just super curious. Do the unions have any idea that they're a choke point, or do they just not care?
I don't know that I would say they don't care. They do know they're a choke point. I don't know. I mean, I deal with 14 unions on every single musical that I do. And by the way, they're in domino order. So you have to negotiate with this one first. And then once you get that deal, you got to go to this one and they trigger down. There's no universe in any industry where you had 14 negotiators, each of whom had a complete veto card that they could play at any point where you're going to get a particularly efficient system. So what you have, and then on top of it, because it's the arts, like I'll give you one example. If you are a member, Actors Equity, which is arguably the most important, the most powerful union, it's who handles the performers. And Actors Equity is always run by an existing member of Actors Equity. SAG has the same problem, by the way, which is the film version of Actors Equity, right? I don't know that the person most qualified to be the president of a union is somebody who has spent their career as an actor. I'd probably love somebody that had a contract background, a litigation background, negotiation background. And so I can see how
the members would argue that the only people that can look after us is somebody who understands.
I would argue the only person that can advise and inform you is someone who understands. That's not the right person to be at the table.
Totally agree. I'm actually in agreement with you, which is why I asked the question. Is like, it's like, don't you guys understand if the business doesn't exist, you don't get paid? So you're trying to kill it, right?
No, that's right. I mean, the quintessential problem that we have, I no longer sit on it right now, but having historically spent time in many union negotiations, the quintessential problem is you have people that come in and argue to get a greater percentage of zero than a percentage of something.
Right, exactly.
And that is it. That's an insane argument, right?
Yeah, right.
And they also argue against their own self-interest. I remember one particular negotiation, for example, where they were trying to argue for net profit participation on hit shows. Now, I'm not against that. I think all boats should be floated. But what they gave up, first of all, and I shared this with the head of the union at the time, no longer the head of that union, but I said, have you looked at the record business? Have you looked at the film business? Have you looked at television? Let me tell you what's going to happen if you negotiate profit participation. And I'm not saying I'm going to do it. I'm just telling you it's what will happen institutionally.
Yeah.
They will change the definition of profits.
Yeah.
Right? That's like
That's
all
it.
these films that have never turned a profit.
Just change it. Yeah.
Yeah,
just like Prince changed his name. Right?
That's exactly right. So all of a sudden I can record because you don't own me, you own Prince. Right. And so what happens is when you have really well-intended non-experts in pivotal negotiating situations, you just have a lot of lame duck sessions.
Yeah.
And so I don't think it's for lack of caring.
Yeah.
It's just the wrong structure to move things along quickly. So everything's like turning a cruise boat around.
Yeah.
So
Well,
like
bless you for being
slow.
able to get through it.
Yep. Yep.
Yeah.
A lot of coffee and then a lot of other liquids after the day is over. That's
I understand. Yeah. Completely. Did you see my bar over here? Oh, you can't. It's obfuscated.
there you go.
Yeah. All right. So we ran over, but it's been super interesting. Thank you for doing this. That was really, really well done. Thank you.
Our pleasure. Thank you so much for having us.
You're welcome.
you.
Everybody, we're going to make sure there's a way to get in touch. Jerry, we're going to float your name out there regularly. So be prepared.
Not a problem. That's what I'm here for. And thank you so much for having us. It's always, it's always fun to listen to talk about it.
Yeah.
It's one of the most interesting alternative strategies I've run across in my 20 years.
You guys have done the hard work, right? It's really clear. Yeah, I don't think anybody would want to do what you just went through.
I had hair when this process started.
That's right. He did.
Yes.
He did have hair when we started. That's
Yeah.
Oh
true.
yeah, Jesus. Oh
Arthur,
yeah,
Thank you
This,
again.
yeah.
this has been
Thanks.
extraordinary. But
Okay,
we're super happy to talk to anybody about it. As they want more details, we can provide them with the data room and walk them through. We built this so that you could understand, a very niche asset class, and you could, understand and build a financial model to drive it. So, really excited to share our passion for doing well by good with anyone.
great. Thanks everybody.
Have a
Thanks
great rest
everybody
of your
for
week and weekend.
joining. Till next time.
Till next time, take it
Bye,
easy.
guys.
Take care.
Bye-bye.